Good morning. My name's Charles Hoke, and I'm a Terry Alumni Board member. It's my pleasure to welcome you to the Terry Third Thursday at the Terry Executive Education Center. I'm filling in for Dean Ayers this morning, who could not be here. I believe he's a little tired from last week's graduation ceremonies, shaking a lot of hands and handing out a lot of diplomas. But we appreciate you being here. Terry Third Thursday is a monthly breakfast event held here in Atlanta for alumni, students, and networking. It takes a lot of time to coordinate the Third Thursday. There are 9 of my fellow board members who are in charge of this operation. I'm a fill-in today, but we do appreciate you being here. And more importantly, we appreciate our sponsors. Synovus is our primary sponsor, and we're lucky today to have one of Synovus' finest speak to us this morning. Our media sponsor is Public Broadcasting of Atlanta, WABE. We appreciate their support. A reminder, there will be no Third Thursday in June and July. However, I do want to mention that the Terry MBA Alumni Lunch and Learn series featuring influential business leaders who bring local and global perspective on industry trends will be in Atlanta on June 12th. Vicki Williams, Chief HR Officer for NBC Universal and Director for Amlay Capital, will be the speaker. I hope you'll be able to join. Details will be on the link where you register for the Terry Third Thursday. The Third Thursday series will resume on August 21st. It is my pleasure today to introduce today's speaker, Cal Evans. Cal is the Senior Director of Market Intelligence and Analytics at Synovus, where he analyzes market factors affecting commercial real estate and industrial lending. He also leads the company's analytics team and delivers strategic insights. Cal teaches real estate markets and finance at LSU Graduate School of Banking and previously taught finance while getting his MBA at the Terry College of Business. He has also an undergraduate degree at the University of Georgia. He chairs Synovus Economic Advisory Council and Forecasting Committee and serves as the liaison to the Atlanta Federal Reserve and advises various professional and civic organizations. He lives in Columbus, where he's married with 2 very young children and is the president-elect of the historic Columbus Foundation. Please join me in welcoming Cal Evans.
All right, so I'll tell you the real reason that Dean Ayers didn't come this morning. It's because he's heard this speech about 3 times. I'm sure he's sick of it, but it actually leads me to an anecdote about something that Dean Ayers has let me do when we do these presentations. He's let me kind of leverage the UGA student body for amusement to drive a point home, and the point has to do with the lack of starter home affordability. So I'll just show you a few clips here. First off, when we're talking to students or businesses or whatever, we'll use this to talk about, how strong apartment markets are, et cetera. And what we show is that you've got a median home price that since the rate hike cycle, prices went up 11%, but the mortgage payment went up 53%. And we basically say, who can afford a starter home? Now, this is where we have a little white lie, and Dean Ayers has been nice to let us do this. We say that we have a survey where we ask the University of Georgia students who are exiting, could they afford an entry-level home given their expected salary and their student debt level? And we say that there's only 8 of them, and we're surprised about what a low number that is. And the joke comes down to this: the only 8 students who can afford it are our draft picks. Now, 3 weeks ago, I was teaching a commercial real estate class with Dr. Henry Munike, who is one of my teachers at the MBA program. I love him. It's an honor to go up there and teach that. And we did 2 classes. We showed this thing. I'm not going to go into real estate today, which is probably good for you all. But we did first class, we showed this joke, and, it's kind of funny. Y'all all chuckled. It's a morning thing. It made you know that this wasn't going to be bone dry. And I figured, students, it was also Thursday. People party in Athens on Wednesday. So I got it. That made sense. The next class was about 11:30. And that class blew into laughter. I couldn't believe it. It was weird. I mean, I'm like, this isn't Dave Chappelle level. I don't really get it. And I'm walking out with Henry, and he said two things. And the first thing he said was, "Did you see Brock Bowers' reaction when that slide went on the screen?" And I said, "What?" I said, "You got to be kidding." He said, "No, he is here finishing his degree." And he said, that takes me to the second point. He said, that's the first student I've ever had who asked me if they could postpone a test to attend the Pro Bowl. And Henry did give him that space. So with that, and more importantly, Brock bought the house in Las Vegas. So this did happen. It turned out to be true. All right, let me start off just talking about our company. From Synovus, many of you know what it is and who we are. We've been around for a very long time. I've worked at Synovus for 15 years. It's a fantastic place to work. You see the accolades on the right-hand side of the screen. It's a great place for employees to work. It's a great place for customers to bank. It's also the largest bank headquartered in Georgia with $60 billion in assets. We've got a long affiliation with the Terry College, and it's a real honor to be here to continue that. I will say one thing about Synovus that we say it often, but it's really true. We're in this sweet spot. We're a medium-sized regional bank. We can do everything that the large banks can do. So we have an infinite ability to meet needs. But on the other hand, we're not too large. We are also nimble enough to meet demands that come from the customers that can be bespoke or a little esoteric or whatever. So it's really great to be in a place like that. If you're our customers, thank you. If you're not, we've brought some of our bankers. We'd love for them to talk to you. They would love to help escort you through some of this economic volatility that we're seeing, and that's what I'm going to try to do starting now. So getting down to business, talking about the Fed rates. This is obviously top of mind with some of the rates that we saw the actions that we saw by the Fed last week. Over on the right-hand side of the chart, we've got the dot plot. And basically, that's the Fed members showing where their votes are, and you kind of aggregate where they come together. And that tells you where the Fed thinks they're going. Now, they didn't do a dot plot this past meeting, but the general thought is that the Fed is looking at about 50 basis points worth of rate cuts. Now, the interesting thing about the Fed's prediction is, does anybody know who the absolute worst predictors of the Fed movement is? Well, it's the Fed, actually. Ironic there. But I do agree with their prediction. I think we'll have a 25 basis point cut in July and another towards the end of the year. But these expectations whipsaw all over the place. We've gone from a 100 basis point cut in December when Trump first took office, or just before Trump took office, to February where we thought we were going to have no rate cuts because the economy looked too good. That is obviously not the problem now. We're back down to 50, so it can be all over the board. And what's interesting is that while the Fed thinks that they're going to see rates go down like that, the bond market doesn't agree at all. And this is something that's extremely unique in the recent history of economics. Over on the left-hand side, we've got a chart that plots the 10-year yield, which is the green line, against the Fed funds rate, which is the black line. And over the past couple of years, for 3 years, they've been very highly correlated because the Fed's done a really good job of projecting, here's what we're going to do. They don't want to put any surprises out there. But what's happened since really September, when the Fed first made their rate cut in this cycle, is that the Fed funds rate and the 10-year have diverged. They've gone on opposite patterns. And that takes us over to the right. This is the first rate cut cycle since 1989, where 100 days out from the first cut, the 10-year was actually higher than when the Fed made their cuts. And it's significantly higher. It was up to 4.5% yesterday, 90 basis points over where it was in September of 24. So what this is basically saying is that the financial experts are saying we're going to have higher rates. Despite what the Fed says, this is our bet about what's coming. And to dig into what the national experts say, I'm going to show you a few scenarios that we use at Synovus to kind of plot our way forward and reserve for loan losses. Moody's provides these, and we look at 4 of them. The first is, and I won't bore you with the intricacies of all this, but we've got a baseline where all the experts' opinions are sort of consolidated. We've got an upside that's, here's the optimistic case. We've got a downside that's the negative, and then a slow growth if we're just in sort of a stagnant piece. And I want to focus on the downside because this is interesting. If you think about the cycle since February of 22 when we started 23 when we started having the rate cuts, you basically were in a position where if we had an economic slowdown, then the Fed would cut rates. But now we're in a position, conceivably, where if we see an economic slowdown, which is shown here in that negative GDP, then we could actually see rates go up. So this is the definition of stagflation, to take you back to your UGA economics classes. And why is this happening? Well, it's happening for a couple reasons. Number one would be uncertainty on tariffs. That's the big one. I'm not going to dig into tariffs today, but that's obviously what's driving it. The other is the immigration policy, because if we deport a lot of the labor that is being used right now, that would increase some of the prices. So conceivably, we could be in a position where you would see higher interest rates and you would see lower economic performance, and that would be a bad thing. Now, we've assigned about a 20% probability to this. We don't think that this is going to happen, but it's certainly a concern, and it's driven by negative sentiment. I want to talk about a few sentiment indicators that we track in our area to plot our way forward strategically. And the first one we want to look at is the University of Michigan's Consumer Sentiment Index. That number has come down significantly from 79 almost a year ago to about 52. That is a massive plunge. It ain't going to surprise anybody that these sentiment numbers have come down dramatically as tariffs have come into play. Now, when you see consumer sentiment go down, then you can expect that commercial sentiment is going to go down too, because those are the customers that are consuming these goods and services. So you look at what is the longest data metric. I almost have to take a breath when I say this. The National Federation of Independent Businesses Small Business Optimism Index, that's a killer, has gone down from about 105 to 96, and that's a pretty big drop. Now, it'll go down more. A lot of this has to do with small business concerns about the volatility going forward, and I'll cover that in just a little bit. We also look at the commercial side, at the manufacturing sector and the services sector, so basically goods and services. And when you look at the manufacturing indices from S&P and the Institute of Supply Management, those numbers are basically bracketing the 50 point. We've got one just over 50 and one just below 50. And that's important because if you live in nerd land like I do, this is called a diffusion index. And what that means is that if it's above 50, you've got economic expansion. And if you got below 50, then you've got economic contraction. So this is showing that manufacturing has a little bit of a negative bias, but it's just kind of still, it's static. And on the services piece, you've got an issue that concerns me. You've got large numbers just going back to even December. The S&P number was about 57. Now it's down to just over 50 at 50.8. So this is telling us that consumers are worried about their discretionary income and their consumption, and so they're pulling back. These have forward-looking elements, so they're reflecting that sentiment. The reason that I'm more concerned about services is that when you look at consumption as a component of GDP, that consumption is about 70%. Of that 70%, divided between goods and services, services represent 70% of consumption. So in terms of the category that you really want to see doing well, you want to focus on services. Now, in the intro, they said that, we're in an analytics group. Analytics is a word that's thrown around a little too liberally right now to basically describe a whole lot of different processes. And I'm going to show you two proprietary pieces that Synovus has to show you what our business operators are saying about what's going on in the market. The first is a tried and true qualitative method. It's just a survey. We survey our commercial customers. We ask them what they're thinking, how they're doing, et cetera. And I'll cover those in just a minute because those answers are really revealing and interesting about what's coming up. The second is an advanced data analytics piece where we look at about 25 million data pieces each month and we consolidate them. It's called a cash inflow outflow analysis. I swear that will be the only piece of math that we do today. And since you're here, I think you've got the intellectual capacity to handle it. But before we get into that, let me start with a survey because it's really sort of the easy and fun part. And when we ask these questions on the survey, one of the first ones that we ask is about business activity. And when we poll our customers, we've got three sets of answers. We ask this question, what's your expected business volume in 12 months? So what do you see a year out? If it's green, the respondents are saying that they see higher levels of business. If it's red, they're saying lower. And if it's blue, they're saying the same. And this is a 5-quarter run, the most recent being first quarter. We did this survey, and this is important. We did it at the last 2 weeks of March and the first week of April. The respondents were split 50% in March and 50% in April. So what that means is that 50% of these responses came in after the so-called Liberation Day. So that does influence these. I think that is actually a little bit worse than what you're going to see here. But when you look at future business activity, we had a great number in the first quarter. We had 43% of our, 41% of our respondents say that they expect business to be higher a year out. So that's great. What's even better is that mirrors the same reaction that they gave in the fourth quarter, which came on the heels of the election. And we all know for a lot of small businesses, medium-sized business, it was party time when the election happened and the economy looked like it was going to be on fire. So I expected that to come down a little bit, but it did not. What did change were the number of respondents that said that they expect a lower volume of business. And it almost doubled from about 10 to 17%. Now, that's not a huge number. It's certainly the minority of the survey, but it's worth watching and it's worth remembering because we're going to talk about employment in just a minute. Now, switching from business activity to our second thing that we cover, basically margin, let's talk about input prices. So inflation's in basically the low 2s right now. We all talk about it going down. We've had a good run for a good while now, showing deceleration that prompted the Fed to cut their rates. But what's interesting here is that when we ask our commercial clients, are your costs going up for material inputs and labor, we've got 42% of them that are saying that those costs continue to increase. Think about that. Over 40% of our business customers are saying that they're seeing inflation go up. So there's a disconnect between what we're seeing at the retail level and what we're seeing higher up the supply chain. So keep that in mind. What's good about this slide is that it's come down significantly from a year ago when it was 56%. So that's the one positive, but still concerned about 42%. And the reason that I'm concerned about that is the next question we ask them is, can you pass these costs along to the customer? And what we see is that we have a much lower number of customers that say they can raise prices, 28% of them. And it doesn't take a math genius to know that if 42% of people are saying my costs are going up and 28% of them are saying I can pass those costs along to the customers, then there's margin squeeze there. People are losing profitability on that end. And that's really concerning, especially in this environment where there is a risk of higher inflation related to tariffs, inputs, and things like that. So another thing that we're hearing on margin from our customers, and this is interesting, is that they are going through their customer lists and they're analyzing all of them for profitability. And I've heard this from large companies, which makes sense. Everybody does this. They check their yield rates on investments and they adjust accordingly. But what's surprising me is that I'm seeing this in the smallest businesses. It could be, the Ray's Heating and Air in Hayhire, Georgia. That person is going through their list, and Hayhire is a great place. No offense to that. But they're looking through that list and they're saying who is profitable. And all of them may be profitable, but they're cutting out the bottom 20% so they can focus on the top 20% and increase their profitability. And think about what that does. It creates sort of a margin spiral for small business. If you've got suppliers cutting off their bottom 20%, then that bottom 20% has to go find a new supplier. And they're either going to be less reliable or they're going to be more expensive. And that cuts into their margins even more. So if there's something that I'm really watching out there, it's the issue of margin compression, especially at the small business level. Now, in our survey this year, we had a bonus question. We asked our customers, how are you going to be impacted by government policies and programs? And this had some really interesting responses too. I wasn't quite sure what we were going to get here, but you've got about 70% of the respondents that say they expect some sort of impact, about almost 20% of them saying that they're going to see a fairly significant impact. And when we ask our customers what's going to impact you the most, the number one answer that we got was downsizing the IRS, the risk to the government going in and cutting that down. And normally you may think, okay, well, that's really not a bad thing. Nobody's dying to pay these taxes. It gets pulled back a little bit. But think about what these small businesses are going through. Small businesses, attorneys, and accountants all said that if you downsize the IRS, that's going to push out the wait times of trying to resolve issues to such a point that it's going to take 2 to 3 years instead of about 1 year. And that's putting them all in a bad position. So I thought that was interesting. I figured that may be just somewhat unique to our customer base, but that same National Federation of Independent Business survey that's a mile long, that was the number one issue from American businesses too. All across the country, they said IRS downsizing was the big one. The second that we noticed came from hospitals and doctor groups. And what they were concerned about was that DOGE efforts would cut back medical expenditures, and that would lead to lower reimbursement rates, and it would lead to lower demand for medical services, especially discretionary ones, from patients. So think about that. That makes perfect sense. The third one would be any of these companies that rely heavily on government contracts or have companies that are customers of theirs that are driven heavily by government contracts. I saw this a lot on the small business front that live off, the philanthropy front, where they live off of grants. They're really worried about those being cut back and driving them down. So those are the negatives. But the positives is that some people see in the DOGE efforts some real efforts to cut expense and contain costs and make a more efficient environment. They also like the fact that if the tax plan is basically kept in place as it is, corporate taxes will be lower, and that's obviously a positive. And they feel good about regulation being dialed back. So it's not all a negative. The second bonus question that we have deals with tariffs. If I can get my clicker going, we ask them the same question here: who sees an impact? And it was a very similar distribution. About 70% say they saw some sort of impact, and about 18% said substantial or severe. And this is where it got interesting to me, and it really showed my own bias, because I'm a free trade guy for the most part. And when I hear tariff, I think negative. That's just where I go. What I saw in the substantial impact was a really, really wide range of responses. And basically, I saw the response that I expected from one of our customers who imports patio furniture from Vietnam. Now, if you think about when the reciprocal tariffs were in place, Vietnam was one of the hardest hit. They were going to have a 46% tariff rate. So this person was going to have to pay that 46% duty on the furniture. He's going to import it into America, and he's got a good that's highly correlated with single-family residential sales. Think about that. You buy a house, that's probably when you're most likely to buy patio furniture. I've lived in my house a pretty good while. I have a chair that is literally black, white, and green from the different coats of spray paint that has been given over the year. So you buy it when you get a new house, and he's constrained on the input cost side as well as the demand side. We also saw ranges of people that looked at the tariffs as a positive, and they too marked substantial impact, but that they meant this is going to help. One of the ones that we saw in Tuscaloosa, Alabama the other week when we were on our little college tour was a client who mines Alabama metals. And so they're pulling tariff-free metals out of the ground, and they're going to sell this to U.S. distributors, and they can't wait. They're angry that these reciprocal tariffs were pushed off. They're angry that you've got some of these issues. Now they're happy about the steel tariff. But the bottom line is that they are going to be able, because a lot of this steel is imported, they're going to be able to raise their prices, get more market share, and be more profitable. So this is great for them. It may not be great for the people buying steel, but it's good for this company. And then we had sort of a middle response. This was a client that we saw in Brunswick last week. He said, I make domestic goods, and I mainly make them out of domestic components, and tariffs would help me. But there are two parts in what I build that come from Germany, and those two parts could get popped heavily, and it would totally erode my profitability. So my question is, if I can get an exception for these parts, I'm for them. If I can't, I'm against them. So you're seeing a very, very wide range of answers there. Now, my prediction on tariffs, and this is a slide that we recycled from 2018 and 20, and this was back in this day, and today you would see her name on the title slide, but my lead analyst, Brooke Blackwell, who's in the back of the room, helped make this, and we were tracking the trade movements in Trump's first term. And what you see is that the cast of characters are basically the same. It's a focus on Mexico, it's a focus on Canada, it's a focus on EU, and it's a focus on China. The materials, steel, aluminum, copper, chips, all those things. It's really not that much different. What's different is the scope and the breadth of what's going on. It was much, much smaller last time. Now, I've got two dates highlighted. The first is March 18, and that's when the trade war was officially launched in Trump's campaign, Trump's first tenure. The second is September 30th, when we put into place, or we agreed upon, we didn't sign it, this is important, we agreed upon the not so creatively named United States Mexico Canada Agreement, USMCA. It took 6 months for that to go down. Note when it happened. It was the fall of 18. So you had a pretty good stretch of time, a little bit over a year before the next election. So this had to be wrapped up so that we could forget about the economic pressures and inflation that we could have seen here. And that was light. This inflation would be heavier because the Chinese yuan devalued a lot in this last one, but it took 6 months. I think that's roughly what we're seeing here. The trade war started in February, technically the full-on deal. We're trying to work these deals. We've got a bunch of 90-day deals in place, et cetera. But think about Trump's position now. And more importantly than Trump are his congressmen and senators that are going back to some of these town halls, and they're hearing from their constituents their fear about tariffs, or their wish that tariffs get put into place, and why is it taking too long. There's just so much volatility out there, and people are expressing their opinions in these town halls. It's a little bit volatile and loud. So they're going to have to wrap this up, in my opinion, probably late summer to late fall, because we're going to have at least a year to get over this. I mean, this has been extremely stressful in the financial markets, and we've got to have some clarity. The other piece is Trump needs lower interest rates. We've got to have them. And if you listen to Jay Powell's comments last week on the Fed's rate movements, he basically put it right back on Trump, who is requesting lower rates. And he said, well, we'll cut rates when we see a more clear picture of our policies. Put it right back on him. So it's a little bit of a chicken match going on between the president and the Fed. So I think it's going to be about late summer to late fall. Hopefully that's wrapped up in short order, and we can get past some of this opaqueness in the forward picture. All right, now we're going to get into the math piece. So I'm going to take a little sip of water here. We have a tool called our cash inflow outflow analysis. And this is the one that involves the 25 million data points. Brooke and I look at this every month, and we basically compare industries. We see how they're related. And what this is showing is that we take all of our commercial customers. Let's say we've got hair salons as a customer, and let's say we got 1,000 of them. We'll look at all thousands of those accounts, and we'll add in all the money that came into those accounts. Then we'll look at all the money that came out. And we'll look at that net figure, and we'll compare it to a year ago, same time period. So we can basically have an almost real-time temperature check on how those industries are performing. And when we look at the cash that's coming in, that's the blue line. Those are the inflows. It's essentially a proxy for revenues. The red line are the outflows, and that's a proxy for expense. So it really shouldn't surprise you that if you go further back in time, and this starts in 2021, that rate of outflows is higher than the rate of inflows. What is that? That's inflation in the chart, very definition. But as inflation's come down, you've seen those come together, and we've had a little bit of a dip over the past year in the inflows. Now, just because an inflow is negative doesn't mean that it's bad. It just means that it isn't quite as good as what it was last year. So when we aggregate these things, we do it at two levels. The first is the NAICS two-digit level. Now, NAICS is the North American Industry Classification System. There are 24 different industries at the two-digit piece, and we try to look at this and say, okay, which industries are doing better that we might want to pursue, and which are doing worse that we may want to look at. If they're existing customers, how can we help them with that risk? If we're looking at new deals, is this something that we want to do? And what you see is out of those 24 NAICS codes, you have 8 that are positive and 16 that are negative. And if you dig into this list, there's a theme. Of the top 8, almost all of them are service industries. When you look at the bottom of the 16 that are negative, you get manufacturing industries, you get retail, especially of discretionary goods, and you get transportation of those goods. And we'll get into that in just a little bit. Now, we'll say here that if there are sectors that have been particularly resilient to these margin pressures and have routinely showed up pretty well in services, it's anything that's aimed at the health industry or an upper income bracket. And we'll see that. in just a moment. Now I'm going to start at the top of the supply chain with NAICS 32, which is manufacturing. And the only thing you need to know on this slide is that chart, if it goes below the red dotted line, that's negative. And if it's negative, we want to comment on it. And in manufacturing, we're down about 6%. That's pretty substantial. 1, 2, 3, I can live with. 6, I'm a little bit worried about. When you dig into all these industries at the 6-digit level, and that's when it gets extremely specific, like hair salons, we can identify which components here are doing well and which are doing poorly. And it won't surprise you what's doing poorly. Sawmills, down 12%. Why is that? Because we're not building any single family residential housing right now. We want to, but we're not cranking out lumber. When you look at what's doing well in this sector, it's infrastructure components. It's things like concrete pipe manufacturing. Brooke and I have talked about this a lot. You go 3 or 4 years ago and you're on the interstate, we're always driving around talking in these markets. You would see lumber trucks, trucks with pine logs. You would see roof trusses. They were all over the place. Now, what do you see? You see huge pipes, you see bridge components, and you see car trailers full of expensive vehicles. Those are the 2 things that I see the most. And we're going to get into that in just a bit. Now, let's go one step closer to the consumer and look at transportation and warehousing. NAICS 48 is transportation specifically. It's been down a while. And this makes sense because what are we shipping that's doing poorly? It's appliances, things like refrigerators, it's sofas, it's carpet. It's these goods that are associated with single family residential sales. That's a major theme here. And we see this backed up nationally. There's an index called the Cass Freight Index that we follow, and it basically gives trends on shipment volumes, doesn't matter what kind it is, and expenses. And what they're saying is that shipments are down 5%, but expenditures on those shipments are only down 2%. So what does that tell you? It proves that there's still inflation in the supply chain. It's almost twice as expensive to ship. So we see that in transportation. The trade war, of course, will exacerbate this. We've got this knee-jerk thing. Transportation looked horrible last week. Now everybody on earth is trying to line up a ship to get over to China to get as much stuff as they can in the next 90 days. So we'll see this blow off the chart next month. Now let's go to the consumer, retail trade. This is one of my favorite ones. It's down pretty low. If you look at the retail sales in the country, they've been stronger than what we see in these inflows. But here, once again, you won't see things that will surprise you. On the positive end, which is interesting to see, new car inflows were up 17%. And what's driving that? First piece is pulling car purchases forward to evade tariffs. Now, we don't see a lot of that in these numbers. We'll definitely see it next month. But what we are seeing is that the cars that are selling, and we hear this from the dealerships, are luxury SUVs and luxury sedans. It's the upper income group that can afford to pay cash or pay down a sizable amount that are buying these vehicles. So we see that doing well. Another reason that we know upper income is being targeted here and doing well is because when we look at used car inflows, they're down 10%. And they're telling us that their more cost-conscious consumers can't afford a used $30,000 sedan at a 9 to 10% interest rate. It just doesn't work in the current environment. So not surprising there. When we shift down into the single-family residential piece, we see building materials down 14%. We see home centers down 7%. We see floor covering down 11%. So once again, these single-family residential affiliated industries have performed fairly poorly. We've also seen discretionary categories that absolutely killed it after COVID when there was a bunch of free money wind down considerably. And we call these the big boy toys because in Columbus, there was a store where you could buy 4-wheelers and RVs and whatever, and it was called Big Boy Toys. Now, a funny little anecdote here. I'm going to embarrass Brooke for just a second. When we sit down every month to talk about these industries, we get to this section. I say, well, the big boy toys are taking it on the chin. This would include golf carts, by the way. And that's important because Brooke had just purchased a golf cart, and she's from LaGrange. She lives in this idyllic neighborhood. It's like a modern Norman Rockwell painting. You just need to paint an iPhone in everybody's hand, and you've got it. Every street in this neighborhood is named after a flower. It's great. They have house parties. Everybody knows the kids. They're like 53 slow down kid signs. I saw that because I picked her up yesterday. And she looked at me and she goes, I bought that golf cart. I bought it, not my husband. So the fact that we make these kinds of purchases inherently male bothers me a little bit. Why do we have to call it big boy toys? And I thought about that and I said, okay, well, here's an alternative. How about adult toys? And she goes, she, she said, no, that's far, far worse. So we stick with that. She just takes this on the chin every time we do it. All right. So to reinforce the retail trade on the income front, when we look at what's doing well in another NAICS code, just because there's so many retail trades, you got to have two big categories. Two that are doing extremely well: art galleries up 10%, jewelry up 8%. Once again, it's catering to that upper income group. Now, I know for those of you in Atlanta, I've heard from people like Ridley Howard and Spalding Nix that this industry is slowing down a little bit because of the discretionary income and some paralysis in Europe. But, and that's where we could get hurt in this economy if you do see the upper income slow down and slow their consumption, because this is what's been driving the growth. Now let's get out of goods and talk about services, because this is where we do have some positive news. Finance and insurance inflows are extremely strong. Think about why. On the insurance side, premiums are up so much that boosts up inflows. Now we can't look at this. This is not profit. It's just money that's coming in. So a lot of that insurance money is going up to the mothership to be paid out in claims, something like that. Where you see real money being made is on the finance side. And we see wealth categories like investment banking up 6%, portfolio management up 4%, trust activities up 1%. Once again, services that are doing better aimed at the upper income groups are the ones that perform. Now, I've beaten up on real estate pretty significantly, but you'll notice that I've only beaten up on one kind: single family residential. And if single family residential isn't selling, what is it doing? Well, it's certainly renting, as are apartments. So when we look at the inflows that are doing well in real estate, residential renting is up 5%. Self-storage, which we're going to use when you're in transition, is up 3%. So those categories are doing pretty well. There are some categories here that show positive growth that we kind of have to look at and put an asterisk on. And one of those are real estate appraisers. Their inflows are up 5%. That would make you think, okay, real estate volume's coming back. That's a good thing. But if you ask any real estate appraiser, and that's what I am by trade, I'll go ask my brethren out there, how was last year? And they will tell you that 2023 and 24 were the worst 2 years they'd seen in about 50 years. So coming 5% up from the trough in your industry going back 50 years is not good. And that takes us to a lesson for 2025. When you see an article with a percentage number in there, it's clickbait. You need to make sure about what's making up that headline. I mean, I'll give you an example. Multifamily rents doubled in 2024. They did. They went from 0.2 to 0.4%. But that's what they want you to click on, and that's our job at Synovus, to dig under the hood and see what's really going on. Professional, scientific, and technical services doing well. Scientific consulting. Legal's up, which is surprising given lower M&A and lower single-family residential sales. So you're seeing some real volume there. That's good. I would imagine any lawyer that's associated with trade and tax, that's going to shoot through the roof over the next year for sure. Veterinarians up 2%. And I mentioned that because I can testify to this. We spent $1,500 having my greyhound's teeth cleaned the other week, and I hadn't spent that much on my own teeth in 5 years. So they're killing it. And it's interesting that in Columbus, out of the 20 vets that we have, only 2 are not owned by private equity firms. So that really shows you how much the economic landscaping is changing too. And when you look at the negatives here, this isn't going to surprise you. Indoor, outdoor advertising down 9%, marketing consulting down 10%, advertising agencies down 1%. If you're a small to medium-sized business and your margin's getting squeezed, what's the first thing you cut? Marketing. Now, I have many friends in the ad agencies that will tell you that's the last thing that you should cut, and they're probably right in some cases, but this is getting drilled in the current margin-pressured environment. Healthcare and social assistance is a little bit down, but that was driven a lot by assisted living and senior housing, and I'm not worried about that, because over the next 5 years, we're going to have 18 million new people aged 80 and above. So the demand's there. It's just, do they have the wealth to consume the type of product that's being developed? And it's expensive to develop that stuff too. I think that's another thing that bodes well for the sector. It costs so much to build that the existing properties are worth more, because that's what people are going to acquire. So that takes us through our inflow and outflow piece. It's certainly been a much more interesting year than I expected. I knew, when Trump got elected, I looked at Brooke and I said, bring your helmet, because we're going to see the workload at least triple. One thing you could say about Biden's presidency was he never met with the media. You didn't have to watch the news, and he never came out of the office. That certainly is the opposite of the case now. So we definitely work hard. But it's also been a super cool environment to be in if you do what we do, because there's just so much, so much fascination in all the movements that are going on. And it actually reminds me of the kind of work that we do from an innovative perspective and a workload perspective that we saw in COVID. But the big difference is we did this to ourselves. Whether you like it or not, this is self-imposed. COVID came on us and we had to respond. This theoretically could be turned off tomorrow. So that's what makes it even more interesting. Now, I do have a fairly positive outlook, and I want to talk about the year ahead pretty quickly. To go back to the Brock Bowers example, let's look at residential affordability. This is the number one thing that I think we need to get the economy moving in the Southeast. This chart, the black line, shows single-family home sales going back about 5 years. The blue line shows mortgage rates. So it doesn't surprise you that while you see low mortgage rates, you see tons of home purchases. And as soon as those mortgage rates start to go past 4.5% and into the 5%, you see the home sales swoon. They drop dramatically. We all know that happened, and it was not fun in the first part of the rate hiking cycle. But you'll also see that home sales spiked 3 times after that period. Once we got a little bit used to thinking, well, maybe a 5% mortgage sounds pretty good when the rate is 7%, you see that as soon as that mortgage rate got down to about 6%, home sales shot up. So our theory on this is that if you could get mortgage rates that hit 5%, then every single one of those industries that I said is doing poorly because it's associated with single-family residential lights up like a burner on the stove. This is a huge opportunity, but it's the rate environment that's keeping us from it. Last year, I thought we would hit a 5% mortgage rate at the end of 25. Now I think it's the end of 26. And those yields, treasury yields, are extremely sticky. You hadn't mentioned this yet, but the debt loads that we have, the increasing debt loads, continue to push those up and give us some resistance. But if we could get this, and Trump certainly knows it, then you would see that economy pick up. Moving from residential to commercial real estate, you've got some nice factors out there that really could promote growth. On the left-hand side, there's a chart, part of it's from the Federal Reserve. The blue line shows the number of banks that have tightened their underwriting criteria over the past quarter for commercial real estate loans. This is the Fed's senior lender survey. They asked the bankers what they're doing. And this is basically flat. It's down to 0. The banks are not ratcheting standards up. They want to make commercial real estate deals. And the orange line shows the year-over-year growth in the commercial property price index. So this is an amalgamation of all different types of properties. But what you see is that it went down significantly as rates went up. And now we've seen it come back up. So you're seeing those property values hanging around the 0% mark. And it matters, office maybe down 10 or 15, warehouse maybe up 10. But what that's telling me is that you've got banks that are ready to lend, and you've got real estate values that are sitting at 0 and are trending up. And on the right-hand side, you've got a graph that shows borrower demand for commercial real estate loans, and that's almost level 2. So this is a perfect scenario to see commercial real estate growth. The problem is we've got to have clarity in the economy before anybody makes a move on this, and we've got to have a real good idea on rates. And they're still high, and with inflation hanging in there, as we saw on the supply chain, it still costs a whole lot to build a viable product. All right, I'm going to close with this on the strength of our footprint. I call this the win-win-win slide, because what it's focusing on are population, jobs, and wealth. And this is our 5-state footprint at Synovus. Within this 5 states, go back to last year, we had 1.5 million people move in. We had 1.2 million move out. So about 300,000 net population in migration. That's an okay number, but what really will blow your mind is that these new residents that we have are far, far wealthier than the ones that leave. And how we know that is we look at adjusted gross incomes from the IRS for people who are moving from state to state. And what will blow your mind is that in 22, the last year that we have information for this, once again, if they downsize the IRS, I won't be able to update this slide, so that's a problem. But the bottom line is that we can look at adjusted gross income from who left and who came in and look at the net. In 2022, we gained net $47 billion in adjusted gross income that can fuel this economy, just in 22. Now, that obviously would come down a little bit in 23 and 24, but these are massive numbers. Florida was number one. Georgia was number two in that group. So just huge, huge numbers when you look at the economic power and fuel that are in place through these incomes. And I also want to point out that this is a adjusted gross income gain. So this is once you finish your taxes, that's your number. Now, you know people cheated on their taxes. So this number is probably a little bit higher. I would say it could be 50, 55. You never know, but we don't have a scientific calculation for that. We're going to see this momentum be maintained because what's driving this is business growth. Florida's the number one state in the country for business growth. Georgia's number 5. And this isn't just this month or this quarter. This goes back to the beginning of COVID. This is almost, a 5-year run of amazing business growth. And it is to some degree what's generated that AGI number. We also have all 5 states in this footprint that are in the top 12 for expected population growth. The national projected gain is about 8 million. Georgia and Florida alone account for a quarter of that growth. So much growth potential here. Now, I've kind of focused on Florida as the big engine, but think about what's happening in Florida. It's become extremely expensive to live in Florida. So if you're in Jacksonville and you have a manufacturing job and you're making $70,000 or whatever a year, and your taxes have gone up on your house, your insurance has gone up, and your house is just maybe too much that you need from a value perspective, what looks appealing is driving across the border to Statesboro and working at the new Hyundai plant and making just as much money, but paying Statesboro real estate prices instead of Jacksonville. So I think that we've seen a lot of movement in Florida, but you're going to see a movement back into Georgia, specifically in the South on the coastal regions, especially with some of these manufacturing places that we see. So I think Georgia's going to be the big beneficiary of that. And I'll close this by just showing you our, propaganda here for our tiny department, the 3 of us. Please use our LinkedIn codes on the front of this deck, and this will be, I'm sure it'll be on LinkedIn, and I know that Georgia will distribute it too. We have our email addresses. We send out market information about every 3 weeks. For those of you who are old enough to remember what a Reader's Digest is, it's basically that. It's what we thought was important and cool over the past 3 years. And we also give our movie and television show recommendations. That's a holdover from COVID. And we always throw in an entertaining meme. And depending on which of the 3 of us is doing it, there's always one effort to humiliate the other one in the memo. So at least for that, it's fun to get. So for that, thank you very much for having me to the University of Georgia. You've been great host. Christine, thank you so much for making this extremely easy. And with that,
Cal, thank you. And more importantly, thank you, Synovus, for your support and all the team members here. Cal, it's a tradition that we present a token of our appreciation, a trophy, so to speak, for our third Thursday speakers, red and black,
Nice.
Personalized. So
Excellent.
you put that on your cadenza.
Right up.
Take
Thank you very
it,
much.
take it home with the team. Thank all y'all for being here. Enjoy your summer. Don't forget to get your parking validation ticket. And one final reminder for the alumni, we got one last chance to get your brick, your engraved name on a brick. Please see Sophia and Laura Ashley on the brick table as we leave. Buy a brick, please. I was told to push the bricks this morning. But we do appreciate it. I always call May mayhem, especially if you have young children. It's kind of worse than December. All the events trying to get to summer, but everybody have a safe and fun summer. Thank you.